Another area where people are starting to feel down and on the bottom, not necessarily seizures, is around lousy earnings, shrinking bonuses, and hundreds of thousands of job cuts. Wall Street is facing some of its darkest days. But it's not just here in New York. The turmoil has rocked the global financial services industry. For part 4 of our bonus check series, we're headed overseas. John Purcell is the founder and managing director of Purcell Co, which is an independent executive search firm based in London. He joined us this morning from our bureau there. Good morning, John.
Good morning.
John, we've heard from the options group that they're expecting a 35 to 40% decrease in Wall Street bonuses. Is that the case in London?
Oh, it certainly is, and possibly more to come, because obviously with our geographic proximity to the European Union and all the troubles that's going on in the euro area, there's a greater sense of immediacy about the impact, which I think is being a little bit delayed when it comes to the United States, even though people who are informed realise that it's going to have an impact there as well.
So for your clients are normally the big banks. Is that still the case? Are they hiring?
Well, some of them are. I guess the big area is anything to do with risk. For years and years, up until quite recently, anything to do with risk, be it risk management itself, compliance, audit, anything like that, was very much the ugly duckling of the banking world and sort of lumped together somewhat unfairly as the business prevention unit. Whereas nowadays, everybody realises how important risk management actually is. That's the one area where we see growth. Also in private wealth management, although that's a much smaller aspect. But all the other major areas of banking are under pressure, and
but John,
we are facing that.
What are they paying for these risk management jobs? Because traditionally, as you mentioned, risk management is the ghetto of the trading floor, where it might be a valued position. It's not one that's highly compensated.
Well, that's changed quite dramatically, even in the last couple of years. We've been involved in the placement of and hiring of chief risk officers, and we've seen their salaries literally double in 18 months.
And do you think this trade to the boutiques, is that where all the layoffs are going? I mean, boutiques are boutiques for a reason. They have to stay small.
Well, they are. They have a little more flexibility. In the UK, there's quite stringent rules about paying bonuses, and the smaller operations can actually avoid those rules, which gives them flexibility around their costs, whereas the big banks are now, for those existing employees, are paying higher salaries due to the fact of political pressure, meaning that bonuses are absolutely a devil word. It's absolutely toxic, the word bonus in the UK.
How much control do shareholders have right now, or influence over bonuses? We read in the FT over the weekend, they're sick of seeing bankers' bonuses rise as share prices tumble, and shareholders really just get the brunt of it all. How much influence do they have over bonus pay this year?
Well, there's a sort of theory and reality there. Supposedly, the senior independent non-executive directors should be acting on the shareholders' behalf. But there's been a strong feeling that they've taken their eye off the ball and have really just gone along with what the executives want to pay themselves. So what we're certainly calling for from our side is stronger action from the non-executive directors, because if there isn't, we're going to see most likely legislation around pay, which could be very damaging and have, as always with political issues like this, have unintended consequences.
Thanks for joining us this morning, John. That's John Purcell, founder and managing director of Purcell Co. He's joining us from London.